Hello and welcome. Welcome to the sixth run of the Economic Outlook webinar series. This is actually the most highly anticipated series of the lifelong learning. And I can see already over 3,200 people joining us today, actually around across the globe. I'm Marina Sforza, an economist and a current Gamba student, and I'm your moderator for today. And we all know why we are here. The world is moving fast, hourly fast, and headlines are super contradictory. We are all trying to figure out what 2026 will actually look like. And to give us a roadmap, we have the one and only Antonio Fatás with us. He's a professor of economics at INSEAD and a famous global economic advisor. And most importantly, he's the person who helps you navigate through the noise. This webinar will be recorded, and it would really not be interactive without you. So please start asking questions in the chat as soon as Antonio starts. And I will be your extended hand to bring all your questions to Antonio. So please keep the questions coming, and also especially the upvotes if there is already something somebody else asked. So now please join me in welcoming Antonio Fatás.
Thank you, Marina. And it's great to be back here a year later after a webinar that we did, of course, in 2025 and trying to see what has happened in the last year, what is going to happen in the next year. Now, what I plan to do is look a little bit backwards to what happened in 2025, because I think there's a little bit of a surprise that on one hand, many things have happened. There was obviously all the tariffs, there was a lot of uncertainty, and some people feel that maybe the economy has not reacted that much to all those things. And as we look forward to 2026, we face very similar questions. We're going to have some events, some policy changes, and we're asking how much should the economy react to these events? So let me do that start. I'm going to go backwards to 2025. And I'm going to ask a question. Imagine you had not read any news in the last year, which I'm sure all of you have, and you look at some basic data on sort of the world economy, how fast it grew every year going back to 2000, and with a couple of forecasts from the IMF for 2026, 2027. Now, if you look at the data on growth, it has been very, very flat. Post the crisis, the COVID crisis, we've seen growth rates which are almost identical from 2022 until last year, 2025. And when one looks at the future, at least through the lens of those IMF forecasts, one sees something which is very similar, very much what I'm going to call in this slide, business as usual. It seems that nothing happened last year when one looks at the data. Now, what is going on in the data? What is it that drives this sort of business as usual perspective? And what happened is we had a really very strong recovery post-COVID. So I'm going to show you two columns here across different regions in the world or countries. The first one is going to be the recovery from the global financial crisis. Now, those are growth rates after the recovery from that crisis. And I'm going to compare it with the recovery after COVID, which is going to come in yellow. Now, as you can see, in most regions or countries, the second column, the yellow one, has been quite strong. There's one exception, which is China, which is on a sort of a path towards lower growth, which is special. But whether you look at Africa or Latin America or advanced economies like the US and the Euro area, we did significantly better after 2019 than after 2020. Sorry, after 2019 than after 2008. Now, that strength of the recovery has continued and has given us that momentum to the world economy that we can have sort of growth rates in 2025, which are not that different from 2023 or 2022. Now, many of you are asking, but what about all those things that we went through in 2025? In particular, what about tariffs? What about Liberation Day, which was somewhere in April 2025? Shouldn't that affect the pace of the economy? And the answer is yes, but there are a couple of nuances or several nuances. Let me start with the most obvious one. We all keep track of these announcements of tariffs. First, some of those announcements were reversed, in particular for some countries like China. But there's something else. Many of those announcements do not correspond with the data, meaning a lot of companies, a lot of sectors got exemptions. So the actual tariff that the US imposed on countries around the world was about half of what was announced. Now, I'm going to show you a quick picture from a recent research paper of two economists. The red line that you see here is sort of the announcement, what seems to be written in the law. Those are the tariffs that you would expect. Now, there's somewhere around, on average, if you do an average across goods and across countries, around 25%, that would be the tariff. But in reality, if you look at the revenue coming from those tariffs, you can look at the implied tariffs, the actual tariffs, and you're going to get a number which is less than half, somewhere around 10%. Now, let's be clear, 10% is a very high number compared to what it was a year ago. But again, 10% is not 25%, and that has kept things a little bit calmer than what we expected. Now, calmer doesn't mean that nothing happened. So if you look at the data, let me look at a few countries here. What you're seeing with tariffs matters with the way you look at international trade, exports, and imports from these countries. So let's look at imports, US imports from each of these markets. Now, all of them from Canada all the way to the European Union, going through many emerging markets, have seen tariff changes, tariff increases through the year. Now, what happens to the volume of goods that were exported from these countries to the US? You're going to see that it's a little bit all over the place. While you have some countries, in particular China, where you see a clearly decrease in exports. So we have a clear decoupling between China and the US, which of course it sort of makes sense given what we're seeing, not just the tariffs, but also the rhetoric coming from both sides. But then you have countries like Vietnam, where tariffs have increased significantly, but exports have increased as well. Now, some of this is pure substitution. So what China was doing, Vietnam is doing it today, whether it is the factory has moved or just the goods are being rerouted somewhere through Vietnam. And in addition, you have some particular countries where things are happening which are different. If sort of we look at countries like Taiwan, you see the big increase in exports from Taiwan to the US, which basically says that something else is going on. It's not just about tariffs. And of course, we have to think about chips and all the AI boom that has lifted some of these exports. So you can see tariffs do matter. They do show up in the data. But when you try to look for all sort of bad news in the macroeconomic data, you're not going to see much. The tariffs did not change as much as we saw in the news. And then the effect of tariffs has been quite different across countries, depending on the particular circumstances. Now, having said that, let me bring an issue which might not be too relevant for 2026 only, but certainly for the coming years, what we call global imbalances. So the trade imbalances between countries, we call that the current account balance of a country, seems to be increasing and getting close to the level of where it was in 2008. So despite all these tariffs, we think trade is collapsing, but we still see very large imbalances. Now, these are, you see all those colors and some labels at the bottom, these are the countries that are currently running a surplus. You can see the surplus has increased recently, post-2020, and is reaching levels as a percentage of GDP, which is very similar to the levels in 2007. Now, of course, there's the deficits, which have to match the surplus because the world does not have a current account deficit or surplus. So you see something similar, both deficits and surpluses have increased. Again, this is a combination of what is happening to the tariffs, how is sort of affecting different countries, the policy reaction of some countries. Obviously, some countries are trying to look for other markets and they find them. And you see that in their imbalances, the surplus growing, in particular in the case of China. So I just want to plant this here. This is not a risk for the next 2 quarters, but it's an issue as global imbalances grow. It means more tensions, potentially more flows of capital that could at some point reverse, and that could cause some sort of volatility going forward. Now, let me take sort of a little bit of a zoom on the US now. So what has happened to the US as these tariffs were imposed? Now, the first thing that I want to show you is what happens to the balance or the imbalance when it comes to trade of the US now that imports are more expensive, at least coming from some countries. The answer is not much has happened. Now, this is not a surprise to anyone, any economist who's made a prediction about this. We knew that tariffs will not have a significant impact on the balance, in particular the imbalance of the US. 2025 looks a slightly bigger deficit than the last 2 years. Of course, a combination of many things have happened. This is not just tariffs, but at least you don't see a big macroeconomic effect of tariffs of the US because of the many reasons that tariffs are not as simple as just making things more expensive. People are going to buy less and imports are going to fall. It's a lot more complex. Many of these tariffs are not goods that are intermediate inputs to export from the US. And the combination of all those complications means that the prediction that the deficit will shrink is obviously not borne by the data. Now, what else has happened in the US? Something which is very visible, if you look at that vertical line, that's the beginning of 2025. Now, employment has slowed down significantly. So if you look at total employment in the US, it was growing. These are thousands of people. And at some point in 2025, you see the line has almost flattened to a point that there's no much employment growth. Now, some of these come from the negative effect of tariffs, but also some of these comes from the policies on immigration that is reducing the ability of the labor force to grow with our immigrants. Now, if you look at a particular sector where hopefully the tariffs were going to have an effect, at least if you take the view of the US administration, you don't see it either. So manufacturing employment was recovering from COVID in 2022. That's the first part. Then it has continued its trajectory, long-term trajectory towards declining in absolute levels. Now, post 2025, you don't see much. You could see maybe a little bit of an acceleration, but I would say business as usual, the sector keeps shrinking despite these tariffs. So you see some, if you want, negative effects on the labor market sort of stabilizing and slowing down, and you don't see much of the positive effects that obviously policymakers in the US were hoping when it comes to manufacturing. Now, what else has happened in the US? We were worried about tariffs affecting inflation. Now, have they affected inflation? Again, the estimates that I would trust the most would say yes. It hasn't been a big increase in inflation, but inflation did not continue its path towards 2%. So inflation was coming down from obviously the very high levels during 2022. It was heading towards 2%. Some of what you've seen the tariffs doing here is keeping the line flat. And at the end, you see a little bit of an increase. In fact, the best estimate I can think of is that tariffs have increased inflation in the US by something like 0.7%. Again, that's not a disaster. That's not the end of the world. But that means that inflation is today 2.7 as opposed to 2, which is the target of the central bank. So that's something that we've seen. We might see a little bit more of that going forward because some of these tariffs are only coming in now through prices into consumers or other businesses. So we might see the same type of stubbornness in the months that follow. Now, something else that happened at the same time that has kept the economy alive. So we're looking for the negative effect of tariffs, uncertainty, but it didn't come in isolation. At the same time that we had some of those negative effects, which some of them are visible, we had an economy that started growing fast, in particular because of the investment in the AI sector, in the tech sector related to artificial intelligence. Now, let me show you a quick line to show you how large that investment is. So this is how much investment in sort of IT activities in general. It includes software, equipment, and many other things. How much it adds to the GDP growth of the US. It's going to be noisy. Sorry, I skipped too fast. So it's going to be noisy, but it gives you a sense of levels. And you can see at the end of 2025, that contribution was almost identical in terms of levels to what we see in the 1990s. So the AI boom starts looking in the data like what we saw during the internet years. Now, it's much shorter. We're not done. We just started. But you can see in terms of levels, that was a big boost to US GDP growth. If you want to look at the number, it says something along 0.4, 0.5%. That's a significant boost to a number to GDP growth that kept the US economy at a growth rate, which is consistent to what we had seen a year earlier. Now, part of this is not just investment in AI, it's also that the investment in AI came with a boom in the stock market. So the stock market in the US increased through the year. This is the S&P 500, increased by about 12% return. Now, this means people are wealthier. The stock market today is a much bigger percentage of GDP than it was 10 years ago, 20 years ago, or 30 years ago. So a 12% increase in these numbers means a significant boost to the wealth of the US households. And that means possibly a significant boost or at least momentum for consumption to continue growing. Now, this is not just a US story. Stock markets grew across the world. In fact, the US did not do that well, partly because its valuation was a lot harder or stronger at the beginning of the year. So if you compare the returns on the US stock market in red with a bunch of other stock markets around the world, you can see other stock markets did even better. And that helped other economies also grew and sort of undo some of the negative effects that the uncertainty and the tariffs were bringing. So you can see my story has been very much around the idea that 2025 ended up being, to some extent, a business as usual macroeconomic story. Growth stayed relatively constant through a combination of some negative events and some policies that hurt growth, whether it's tariffs, they hurt inflation as well. But at the same time, we had some good news when it came to investment in the AI sector that spill over to the stock market, and that kept the momentum. So at the end of the day, we ended up having growth rates, which in most cases were higher than the forecasts that were done at the beginning of the year. I think many of us had a lot more pessimistic view in January. It turned even more pessimistic in April. But then as the year 2025 ended, we realized that the economy did a lot better than what we thought. Now, let me finish with one slide before we start taking questions. As much as I just said 2025 is business as usual, it was not. And I put not in capital letters. 2025 for me, it is and it will be, and we can talk in 10 years from now, an inflection point when it comes both to politics and economics. And I think the world is changing or has changed in 2025 in a way that we're not going to come back to where we were before. Okay, I'm going to avoid politics. If you want to listen to Mark Carney giving a speech yesterday at Davos, he's going to make the point about the political side. Let me make the economic side. I think the geopolitical shifts have completely changed the relationship between many countries around the world, whether it's China and the US, whether it's Europe and the US, whether it's Canada and the US, and now Greenland. Now, at the same time, you see these tensions leading to sort of a redrawing of the map of what alliances are. The agreement between Latin America and the European Union, Mercosur, which did not happen in 2 days, but it was signed, is an example of how we start looking at different places. The recent conversations between Canada and China that surprised many is another example. How China has increased its investment in the Belt and Road Initiative more than anything they've ever done before. You don't see that in the news, but that has happened. And there was a recent meeting between China, South Korea, and Japan, where they're talking about sort of joint activities and alliances to think about economic outcomes, something that probably would have been unheard of a few years ago. I think this is something which has started. We're not done, and I don't think this is transitory. I think this is the beginning of what it will be at some point, a new world order. Now, other things have happened, and it's very much centered around what the US is doing. The largest economy of the world has withdrew from the world in many ways and has started using what I'm going to call strategic coercion. The idea that if you don't invest $500 billion in my country, your tariff is going to be 50% as opposed to 15%. Now, that's something which is quite unusual. We certainly have not seen it in a long, long time. And that is something that, in my view, is going to change completely the way people look at the US and the trust in that relationship. And this is not just about one person, the president, one party, one election. I think this is something that is going to last for a long time. And it's going to mean that people are going to have to rethink the way they see different partners, in particular the US. Now, none of this matters for 2026, meaning a lot of those things are going to be slow moving. We're going to start changing the way we think about the world. It might take years or decades to get to a new equilibrium. At the same time, as we start doing that, we can get into crisis because there's going to be geopolitical tension as these alliances move. And that could, in principle, also affect the short run. But again, these are things which I think I want you to keep in mind for the future. But at some point, these are going to be very relevant because we're changing a lot the way the international order looks like. Now, let's bring Marina back and we're going to take a few questions. Marina is going to ask them.
Yes, thank you, Antonio. We actually already have a lot of very interesting questions coming in. So I'm gonna try to consolidate the main themes. So one thing that I saw was a recurring theme about obviously the tariffs, the geopolitics, and the trade fragmentation. So one of the questions is actually that if the main effect is higher, so the main market effect is higher uncertainty rather than the immediate trade collapse or negative trade effects due to the tariffs, how should our businesses actually adapt their investment, their supply chain strategies without sacrificing long-term growth? Should they put on the Philippe Baguillon goggles, focus on innovation?
I mean, I think you finished your question with a sentence where I'm going to challenge a little bit the last sentence, which is you said without sacrificing long-term growth. I think we're going to sacrifice some long-term growth. So I think we're moving to a world where doing business is more costly, it's more complicated. It is not that easy to say, okay, let's all use the same currency, the US dollar. We all speak the same language. Everything is easy. We're going to have to use different currencies going forward. We're going to have to deal with markets that do not say, okay, the US dollar is the language or the currency of everyone. That is a cost to business. It means you have to keep liquidity in different currencies. You have to think about managing exchange rates. Same about trade relationships. It will be great if I only have one supplier, which is the most efficient one, and I can rely on that one. But that doesn't seem to be the case. That uncertainty that you mentioned means I have to be ready to change. So I have to have a diverse set of suppliers, a flexible supply chain in a way that might hurt me when I look at growth. So I think we need to understand we're making trade-offs which are not easy, but you have to adapt to the new reality. You cannot close your eyes and say we're coming back in a year to where we were 2 years ago.
So agility is more important than the forecasts. And then just to go in a different direction. So there's big interest actually in the stable coins was mentioned quite frequently, and also the Liberation Day and the digital guardrails. So I try to consolidate this all the questions that we see in the chat, and so there is growing interest in new digital rails in finance, no? So from stable coins, blockchain-based payment system. And what do you say from a macro perspective? Do these innovations now strengthen the existing financial system? Also thinking about the end of the term of Powell in the Fed, is that something that improves or makes it more fragile?
I think it makes it, again, I'll say something which some of you might disagree. I think it makes it more fragile. I think what we're seeing is the following. Again, I think it's an inflection point. We all feel to some extent that we need to move away from the old model, move away from the US dollar, find alternatives. Now, some people find an alternative in gold. I didn't check today, but yesterday was doing great. Some people find alternatives in stablecoins, in Bitcoin, and we can add many other possible solutions. I don't think any of these solutions will replace the US dollar tomorrow in an efficient manner. I might be happy holding gold, but I cannot go with gold and start doing international business. I might be happy holding Bitcoin, but it's not a currency that is accepted in many places. But people are going to do it. So we're going to fragment the financial market in a way that is not efficient. But people are going to do it because there's no alternative to the US dollar in the short term. So I think we're going to go through a transition when it comes to what you just said, digital payments and currencies, which I think is going to be complex. It's going to add to the uncertainty. And we're going to have to wait a few years to think about what is the new equilibrium. Is it going to be the euro, the Chinese yuan, a combination of both, or something else? It's going to be costly. I don't think that's going to add much to the volatility. It's going to add to the volatility, not fix the volatility.
Thank you. Thank you. I also have a lot of questions about AI, but I think we should go to the next part, and then we're going to answer all of the AI questions.
Okay.
Thank you,
Thank you,
Antonio.
Marina. Okay. So thank you for those questions. Keep writing questions, and Marina will ask a few of those questions at the end. Now, I've spent my first part of the webinar talking about last year. Now, that's going to help me understand a little bit what comes next year. So what comes in 2026? Now, in some sense, again, builds on what I've said about 2025. Now, let me go a little bit through some countries so I don't talk only about the US, although I'll talk for a while about the US, of course. Now, if you look at China, now China is continuing a path towards lower growth, which makes sense because China is richer. Now, it's a path where, to me, the biggest challenge is rebalance an economy that has not been properly balanced for many years. There's too much investment, not enough consumption, and you need consumption to replace investment as an engine of growth. Otherwise, you keep investing in projects that might not give you the right return, and therefore you don't grow as fast as you should. Now, they're doing some of that, but not fully. So on the left-hand side, you see the current account balance of China, the trade balance. So China is not what it was back in 2006, 2007, where the surplus was just wild in terms of magnitudes. But the surplus in recent years has been increasing. So they're not staying at levels which are low, which is what other countries certainly would like to. They're seeing, again, the surplus increasing. And the reason is because they're having a hard time managing that rebalance from investment to consumption. If you look at the two lines on the right-hand side, the current account is the difference between the two, between saving and investment. So whatever the gap is what you see on the current account. You can see investment is coming down. That's good news. It's not 46%. Now it's down to 40. But you can see that saving is coming down at the same time, but not faster. So what China needs is consumption to take over as an engine of growth so that the blue line falls faster, but that's good for growth because you have consumption driving GDP growth. And by doing that, you reduce the gap between the blue line and the yellow one, and hopefully you close the current account balance. Again, that's the issue with China. The current account balance increasing is going to give them trouble with the European Union, because all the things that are moving away from the US have to show up somewhere. So those exports show up somewhere else, and the European Union is one of the biggest markets where they show up. And again, and that will create some tensions, which might not be ideal. Now, I'm going to do a paragraph on emerging markets. Now, emerging markets, there's lots of great, good news. We don't talk about them enough, partly because a lot of the news happens somewhere else. But what emerging markets have shown through the COVID crisis is that they're so much better prepared to deal with crisis. We have not had many emerging market crises for a while, since the global financial crisis. And that's because they've done their homework. They have much better macroeconomic frameworks, central bank independence, fiscal rules, and they're really, really well prepared to deal with the volatility that we see out there. Now, they're trying to hide from all these geopolitical tensions. They're trying not to take side, which is not easy. But as long as global conditions remain strong, I think what we've seen in recent years in emerging markets is very encouraging. Now, Europe is doing their best to handle some difficult times. Obviously, there was the invasion of Ukraine. There was the trade tensions with the US. Growth remains slow. But it's not declining, and growth has been a little bit higher than what we thought at the beginning of the year. Now, the biggest issue here is how they manage the relationship with the US, the trade tension. Now, that is not going away as we speak. That's what I put to be confirmed. There is obviously the new tariffs announced on Europe coming from the US because of the Greenland issue. They'll try to be creative. We see the Europeans trying to be creative, but there could be a moment where this creativity doesn't work anymore and we get into something that looks more of a crisis. The real risk in Europe are much more in the long term. I'm not going to talk much about them. I've talked in other years. Demographics, government debt, those are things which are concerning. I would say not for 2026, but more for the long-term perspective. Now, having said that, let me move a little bit towards the US and remind everyone that business as usual tend to last for a few years, but at some point recessions happen. And we have to think about it. Will 2026 be that year where a recession happens? Now, when do recessions happen? Typically, when you have an expansion that lasts for a long time, maybe too long, it creates some imbalances somewhere in the financial system, in stock prices, in housing prices. And that thing has to be addressed through a set of actions that leads to something that looks like a crisis. Sometimes that's not what causes a crisis, but it's a big policy error, a policy decision, a conflict, a war, a big economic conflict. So these are things that could also take economies to a recession. So if you look in 2026 and you think, will I see a recession? Think about those two arguments. I'm going to try to help you think through each of them. Now, where are we today? Now, we have an expansion, a global expansion, which is mature. We've been growing since 2020, 21. Now, it is not too long. Again, 4 years is not that long for an expansion. Expansions can last 10 years, in some cases, some countries, up to 20 years. So I would not say that when it comes to the length of the expansion, we have sort of a recipe for a recession. What about imbalances? Now, I'm going to point in one direction when I think about imbalances. Are we overdoing the artificial intelligence excitement? And I'm going to say a few things about that. And then I'll say a couple of things at the end as well. Policy mistakes, conflicts are possible, so we cannot ignore the possibility, very hard to predict, but the possibility that some of the conflicts get out of control and lead to a crisis. But let me talk a little bit about that imbalance coming from artificial intelligence. Now, first thing, when you look at the artificial intelligence boom, it is not crazy if you look at the amount of investment that we're seeing. A second ago, I told you investment is increasing, and it is, and is driving part of GDP. But so far, if you sort of compare the artificial intelligence boom of the 2020s with the US tech boom in the 1990s, or the oil investment in the 1970s, or Japan and Australia in different decades, the number is not at all large compared to those other events. So I would not say that at this point, when you look at the amount of investment, has been as large and possibly as excessive as in other countries. But again, that's not the only thing that matters. The other thing that matters is whatever investment is happening, is it going to meet at some point the expectations of return? And to think about that, of course, we need to point towards the stock market. Now, what does the US stock market look like? And I'm looking at the US stock market because obviously some of the companies behind this boom are listed there, and they're American companies. So if one looks at the price earning ratio in the S&P 500, and I'm using here the measure that Robert Shiller creates, which is a cyclically adjusted measure, but other measures would say something similar. So price earning ratios are high. And we know that for a while. This is not news, but with the increase in last year, it's a little bit higher than the year before. So how high they are? Somewhere around 40. Now, that's a high number historically. I'm showing you here numbers only back to 1991, but if I show you 100 years, these are the only two times the stock market has been at 40 right now, and somewhere around 1998. Now, that is concerning because in 1998, it took an extra year or so to get into a crisis and a serious correction of the stock market when the internet bubble sort of deflated. Now, that picture is partial. It only looks at the stock market, the price earning ratio, but it doesn't look at something which is important when we look at the stock market. But what about alternatives? What about interest rates? Interest rates have not stayed constant through these years. In fact, they've been mostly on a declining path, except for the last couple of years. Now, one way to adjust interest rates to calculate something which is called the equity premium. I'm going to show you the equity premium backwards. So it's the reverse of the equity premium to match the picture on the left-hand side. So this is another way to think about overvaluation. Just think about the inverse of the equity premium. Now, this makes 2025 look a little bit better. So now 2025 looks like 2007, which again is still a year which we don't want to repeat from a stock market perspective. And again, it still looks far away from the 1990s. So still the 1990s is sort of the biggest overvaluation, if you want. And then 2007 and today look very similar. Today, a little bit higher than 2007. Now, there's something which is concerning beyond the price earning valuations, which is the concentration of this risk. So we're betting that the stocks, the fact that price earnings are high, we're betting that the stocks are going to give us something great through earnings growth. That's how one could justify those high valuations. But we're betting in a few companies. So I'm going to show you pictures that are not easy to read, so I'm going to read them for you. So if you look at that line that says concentration of risks, it looks at the S&P 500, and it says how many companies account for the overvaluation or high valuation that we see in the market. So if you look at that line, today, 2025, is really the highest level going all the way to the early 90s. Even in the 1990s, if you look at that dotted green line, there was less concentration. There was less bet on a few companies. It was a little bit more broad-based. Now, that says that basically, if you focus on a few companies, sort of the Magnificent Seven, they're really driving a lot of this hype. Now, you might say that's good because those are the good companies. I don't want this to spill over to the other ones. But you also need to understand the risk. What if a couple of those companies fails to deliver? That is a big chunk of the momentum that we have today. So I think the right word for this slide is risk. It doesn't say that this is wrong or right. It says concentration means that we put all the eggs in a few baskets and we really, these companies better deliver. Otherwise, there needs to be an adjustment to the valuations we have today. Now, let me show you another picture of the stock market. That's going to be my last one about the stock market. When you look at these price earning ratios, so they're obviously very high. Historically, do they help us understand future returns? So let me compare the price earning ratio. It's going to be the inverse of the price earning ratio. And let me calculate the 10-year return of the stock market going forward. So if I buy the stock market at a certain time with this price earning yield, what type of return did I get in the next 10 years? And I pick 10 years because if I pick 1 year, it will be incredibly volatile. So this is about long-term return, not short-term return. Now, you can see a very strong correlation. This data also comes from Robert Shiller. You can see an incredibly strong correlation. When the price earnings are high, you see very low returns. Again, the price earning yield is sort of the inverse of the price earning. So when you see moments where the stock market looks overvalued, the 10-year return is lower. Now, there is a little bit of an exception. In recent years, you can see the data stops in 2015 because I need to calculate 10 years forward, so I cannot show you anything after that. In recent years, there's been a little bit of a deviation. Returns have been higher. But let me warn you, we're not going to see that again because that happened because interest rates during those periods were declining from values close to 6% to values close to zero in real terms, adjusted for inflation. Now, when you have that, returns will be higher than the price earning will tell you. So then you will see a deviation between the two. But as long as interest rates stay stable within a reasonable range, you're going to see a very strong correlation between these two lines. So again, this is just a reminder that the stock market could be a source of volatility. It could be a source of surprises, an adjustment of imbalance. I do want all of you to understand there was a lot of these ingredients in the 1990s. Of course, AI could be better, worse than the internet. That's something to be decided. But there's a lot of these ingredients. I just want to highlight one a little bit for fun. October 1st, 1999, the Dow Jones reached 10,790. That was a very high level. People had been worried about the Dow Jones, the stock market in general, for years already, for several years. Now, at that point, October 1st, this book was published, Dow Jones 36,000. It basically said, it's a very easy message, the Dow Jones in 1999 should be worth 36,000. Now, that's a book that ended up not being right. But if you look at the reviews of that book, they were incredibly positive, and they sound so much like the things we say today. We are in the midst of the greatest economic book boom in history. And it hasn't finished yet. It's about to start. It's a little bit our logic today about AI. AI is showing some positive elements, but it's about to start. Now, it better deliver more than what the internet did. And I'm going to do a quick comparison now between AI and the internet, and you'll see the benchmark is quite high. So delivery doesn't mean that it's just good. It has to be really good to justify current valuations. Now, let me show you a little bit of that. So let me show you about whether AI is delivering from the perspective of GDP growth, and GDP growth will lead to earnings, and earnings will support current valuations. Now, AI is supposed to make us more productive. So if you calculate productivity growth in the US, I'm dividing here time before 2020, after 2020, you see a little bit of an increase. So it used to be 1.5% annual. Now it's 2.1% annual. Again, that's great. I've updated this chart from last year. The numbers look very similar for the US. Now, I showed you last year the euro area. If you update the euro area, it doesn't look good. Now, that in my mind is questioning a little bit whether this is only AI. because AI is also in the European Union. We're using tools which are very similar to what others are using. So one has to be careful how much of this is AI versus something else. Now, I'm going to do one thing to try to see whether I can see AI better. I started in 2020 for this calculation. Some of you might be thinking, wait, ChatGPT was only launched in November 2022. So you're looking at too many years. Now, let me show you fewer years. So what if I only count since 2022, since 2023? Now you can see these numbers are going to be volatile. They're going to move a lot when you remove a year here and there. Now, we still see numbers which are, yes, around 2. If you want to be really optimistic, post 2023, 2.2. Now, that still does not compare well with the internet. During the internet years, 95 to 2004, productivity accelerated to almost 3%. We're not there yet in the US. Now, we might have to wait, but the message here is the internet was an episode where we did get very large macroeconomic effects. Growth accelerated, productivity accelerated, but we still had the overvaluations that led to a bubble. So the fact that good news are happening with AI and there might be even better news coming forward, one has to always be careful and match sort of the reality of those news to the valuations that we see today. Now, if you ask me, give me 10 years estimate of what AI will do on productivity, I'm going to struggle. Now, this is not my particular research area. So if I ask other people, some of these people are very famous. A couple of them have gotten Nobel Prizes. The estimates are all over the place when you look at research. Okay, I'm including, obviously, one private sector estimate from Goldman Sachs. It can be as low as 0.3% every year. That is not very impressive. That will not justify the valuations that we see today. If it was 2.5% every year, again, plus 2.5, I'm not saying productivity growth will be 2.5. The addition of AI will add 2.5%. That will justify lots of things, but that number is really high. That's so much higher than what the internet did for us. So one has to be careful putting that in context because those numbers are very high. And to get there, we need a miracle, not just some good technology. Now, I'm going to say something quickly about something which I don't think is too relevant, but some of you might be thinking about it. What about policies next year? This year, 2026. Now, central banks are very much in neutral. They, to a large extent, defeated inflation, to a large extent. They're moving interest rates by some small amount, but they're not thinking about some big policy change that could affect the outlook for 2026. So I wouldn't look there if you ask me about something important for 2026. Fiscal policy in the large 3 economies of the world is going to be expansionary. That's going to help growth. The US, through the sort of budget implemented by Trump, a lot of those things are coming in. You're going to see bigger deficits. The European Union is spending a lot on defense and other things, so you're going to see deficits that don't go down. And China is pushing forward with aggressive fiscal policy to keep the momentum, trying to struggle with that rebalancing that I mentioned earlier. So again, if I see anything in fiscal policy, it's a more movement towards growth in the short run. So that's not a big concern if you're worried about recession. Now, there's some big concerns. I don't want to go too much into them. Obviously, the independence of central banks is being questioned in some countries, some more than others. That could play out during the year. It could. If a crisis starts, we might not have the same type of mechanisms we had in the past. In particular, the US Federal Reserve playing the role of the central bank of the world, because that will become very political. And that worries me that the decisions coming from the US might not be as supportive as in the past. But again, that's if a recession starts. It is not going to happen by itself. It has to be as a mechanism. So let me just finish with one slide and then we'll take whatever questions are left. Now, I want you to sort of, when you think about this year, 2026, I want you to move away from asking for a number. What is going to be growth next year? Because to some extent, if nothing happens, it's going to be business as usual. I can give you the number of my first slide. But really, we'll have to think about what is the chance that growth derails, that we have a scenario that looks like a recession. Now, the chance in my mind, the first risk that I see does come from market valuations, narrative about artificial intelligence that could reverse. Again, it doesn't need to reverse. In the case of the internet, it lasted way longer than what we thought it could last. So it could be another couple of years of market overvaluations that are excessive, but it could, of course, derail today. Again, yesterday we saw the stock market reacting negatively to some bad news. You could have a couple of things like this, creating a correction that takes some of these valuations to much lower levels. Then we have the possibility of policy mistakes, events, policy decisions. I think they're more likely today than 2 years ago. Again, I said before the economy did better than what I thought at the beginning of 2025. But if I look at politics, things have gotten a lot worse than what I thought in 2025. I had no idea that we would be where we are today. So in that sense, if I look at sort of political issues, geopolitical issues, I'm a lot more pessimistic than what I was a year ago, because things turn out as bad or worse than what even the worst forecast I had in my mind. And again, the issue of how the US is doing what I call strategic coercion and maybe dealing with things like the mechanisms to handle crisis, getting rid of them, not collaborating with other countries. It is playing out as we speak. It will play a lot bigger if a recession or something that looks like a recession plays around. So again, my quote unquote prediction, I don't think this is a prediction that is going to be very precise. If AI continues delivering, whether through investment and returns, if we don't see a big policy mistake, we can have a few, but not a big one. I think we'll stay with business as usual. And I'll see some of you a year from now talking about a line that still continues to be flat. But I think we have to think about these scenarios. We have to think about this risk, and certainly the probability of a correction in the stock market, the probability of a policy mistake, or some of these geopolitical crises escalating. I don't think it's zero. Of course, it's not one either. So let's not be too pessimistic, but let's at least think about them. Marina is back with a few questions.
Yes, thank you, Antonio. That was extremely insightful. And we have by now a lot of questions. And I'm already sorry because there are so many different themes, and we're not most likely not going to be able to cover unless we do another 3 hours. But let's jump right into it. So the first one we really need to cover is AI. So you mentioned that we actually do not see the biggest investment boom that we ever had in history. And this is actually a question that is related to Brianne's and Stephanie's question. Hi. So Antonio, we still see the market concentrated surge in AI related investment, particularly in the US, as you said. However, as we now enter 2026, we are also seeing this productivity divergence, where the US is capturing gains while Europe and emerging markets struggle to modernize. So now one question is actually that whether the real cost of capital now is preventing firms outside the tech elite to actually implement these tools. And are we risking now actually a decade where AI widens the gap between the leaders and the rest? And that is trying to cover a lot of country-specific questions that we had in the audience.
I mean, that's a great question, and we could spend 3 hours talking about it. Will AI increase inequality across countries? So are we going to see Europe and the US diverge within countries? So who's going to benefit from AI the most? This is, to me, one of the most interesting areas of research today. Unfortunately, it's too current, and I don't think we have a lot of results. When it comes to inequality within countries, so who's going to benefit the most, the high skill or the low skill workers? You have experiments that give you exactly the opposite result, where is the low skilled people that really improve with the use of AI tools, and therefore inequality gets reduced. But you also have examples, which is the opposite, that people who really are at the front of the knowledge of AI tools, the one that can use them, anyone else is left behind. So right now it's a mix of results, but very partial. Countries is also a very interesting question. Why is the US taking a little bit of a lead relative to Europe? What is going on? And I don't think it's only the use of AI. Because if you look at productivity in the US, a lot of the productivity growth is happening in companies which are behind the production of the technology, not behind the use. Which again, I think that's an interesting paradox because ultimately you want the productivity to be in the hands of all of us, which is what happened with the internet. The big wins from the internet is in all of us. We're doing this webinar, obviously, because the internet exists. So you want that to be more widespread. And if that's the case, I think Europe will also catch some of that because we're using those tools. We will use those tools. Again, I think Europe has to push forward the digitalization of companies, make sure that we all at the edge. But if that's the case, I do think that we will see more an even phenomenon with you see productivity growth everywhere.
Okay, thank you, Antonio. That was a question that occurred for very specific countries like Japan, India. And I was just wondering, is there a mechanism you can think about this problem set so we can give it at hand?
Yeah, I mean, I think other countries, to me, AI is just like any other tech tool. I mean, we've been struggling with the issue of digitalization and using digital tools for many years. Of course, with the computers, I think the internet accelerated that. What we're seeing in the world is a little bit of sometimes countries not able to keep up with these technologies. It is about education, but I think it's a lot about how companies are able and capable of bringing the new technologies to their countries, I mean, to their companies and therefore the countries. I don't think it's new to AI, but again, it's an issue that might become more relevant if AI becomes a boom like it did with the internet.
All right. Thank you, Antonio. Let's maybe jump to a question that also was upvoted that actually is, let me just go through here. So it's another question about China, actually. So do you think China can actually export its way out of this deflation trap in 2026? Or is the global backlash now so strong that this expert-led survival, so to call in hyphens, has its limit?
I mean, I think that's the biggest challenge for China is what I call the rebalancing of the economy. Find a growth model which is healthier from a domestic point of view so that people can see consumption increasing. That's good domestically. You don't have as much investment as today. That means better returns, less inefficiency in investment, but also from an external point of view, so that when you go and talk to Europe, Europe doesn't look at you as being someone who's just trying to dump exports in their market. So that's clearly something that must be in the mind of the Chinese government. The problem that they have is they have not found a good recipe to increase consumption fast enough in a way that they feel comfortable maintaining the growth rate. So I think their obsession with the growth rate, I don't think is good for anyone. It's not good for them. It's not good for the rest of the world. Of course, I understand why they're obsessed with the growth rate, but it might be that they need a transition where the growth rate slows down a little bit and it's okay. But because that's not how they think about it, whenever they don't see consumption increasing, then they feel, okay, I need more exports, or I need to increase government spending, or I need to find a way to invest more. And the model survives. I think they're doing better than a few years ago. So I think, again, trying to stay optimistic, there is progress. And if we navigate a few more years, maybe in a few years, China will be what they're supposed to be. But this is, in fact, the biggest challenge for China in 2026.
Thank you. And now let's jump again back to the US and Europe. So we also have a very upvoted question here that is just a theoretical thought of Laurent and actually Danilo. They ask whether if Europeans stop buying US bonds, what would be the impact?
Yeah, I mean, it's a great question because the Danish pension funds announced, I think it was yesterday or the day before, that they're going to stop buying or they're going to sell all the US government bonds. I've gotten this question before many times. It was about China, not about Europe, but it was the same story. What if China gets mad at the US and they sell all their bonds? Again, to some extent, as an economist, I would say it's not a big deal. One could, in principle, see financial markets absorbing that extra supply in a way that is not very disruptive, meaning someone else will buy them. So if Europe starts selling all the US government bonds, prices will fall, yields will go up, and then someone else will say, okay, now it looks interesting to me, I'll buy them. So the markets are very liquid. At the same time, let's be clear, markets also have the psychology of the market. So if everyone starts dumping an asset and the price goes down, it might be that it doesn't matter what the yield is, that no one wants to buy it. So in particular, given what is happening from a geopolitical point of view, I think today it will be more of an issue. Because I think if Europe truly made that statement, we're going to sell all our government bonds from the US, which is not an easy thing to do, I think the US will react. They will react with more tariffs and who knows what. And I think we will escalate a war between tariffs and financial markets that will go to places which are not good. So again, theoretically, maybe this is not the end of the world. In practice, in today's environment, that would be an escalation of sort of economic sort of aggressivity between Europe and the US.
All right, thank you. And to close off, now a very broad question for you, Antonio. Are we better or worse, in a better or worse position than in 2025? And also, what are the concrete signals for society and our businesses that business is not or might not no longer be business as usual?
I mean, I'm gonna say we're in a worse place, but let me qualify that. Since 2020, I'll tell you my own sort of journey in the last 4 years. Since 2020, I've become more optimistic about the resilience of the world economy. Now, I'm not alone. If you look at the last publication of the IMF, it was 2 days ago, which is the state of the world today, the World Economic Outlook, they use the word resilience everywhere. I think that's a lesson to all of us that the world economy has become more resilient. And that's good news because some country might do something crazy tomorrow and we might all be fine. So I think I've learned that last year, and that gives me the optimism that I started with. I do think the other things that are worse and worry me, I think the possible imbalance in sort of the optimism with AI and the stock market, in my mind, has gotten worse because the market has done well in 2025, and we still don't see a revolution. And I mean a revolution. I don't mean positive things. Positive things we see, but we don't see a revolution in technology yet. And of course, the other issue, I'm really worried about geopolitical tensions that escalate in some way between many, many countries around the world. Of course, the news today is Europe versus the US, Greenland. I do worry that one of those moments, we managed them well in 2025. I think there is a sense of fatigue. Again, I'm going to talk about Europe. Europe is tired of saying yes to everything that comes from the US. And when I say Europe, are both politicians are citizens that they say, okay, we tried to stay quiet, we tried to find an agreement, and look where we find ourselves today. And I see a sense of fatigue that says, look, at some point, one needs to do something which is going to be costly. It's not going to be free. It's going to cost Europe growth. It's going to cost Europe many things. But at the end of the day, it's the only way forward because the world has changed. And as I said, 2025 was an inflection point. I know that sounds a little bit pessimistic, but you're asking me for my views. So I'm trying to be as realistic and as honest as I can be as well.
Yes, thank you so much, Antonio. That was really interesting. And so basically, if I summarize everything, we really have to start thinking about in scenarios. The scenario thinking becomes ever more important instead of just focusing on simple forecasts. Thank you so much. And I hope the audience, for sure, the audience enjoyed it.
Yeah,
Thanks,
thank you,
Antonio.
everyone. Thank you, everyone, for attending. That was great.